what are management's intentions overall, and did they really consider shareholders in this decision?
And that is a serious risk to the business. Do people boycott WWE because of this? I'm not saying that's what's going to happen. I'm just saying that that's a risk that's presented itself.
Yeah, it's an absolute hammer, and I did not see that. And thanks for letting me endorse this company as long as I did.
I'm sorry. Hey everybody, welcome back. This is episode 7 of the Beyond the Edge podcast, where we cover everything growth stock related under 10 billion market cap. As you've seen, we range typically between market caps of $1 to $10 billion, though we aren't afraid to dip into penny stock territory when there's juice to squeeze. I've got my co-hosts with me, trend tracker Peter Pilarchio, Mr. Fundamentals Declan O'Flaherty, and today we've got a couple of good news stories for you. If you find value in what we're dropping here, we'd love for you to subscribe, share with other people you think might be interested. We film this every Thursday, we drop it every Sunday, and if you find any value, a like goes a long way. Today we've got a few juicy stories for you. So gentlemen, let's start first with this deal by Beam. They've had a flurry of contracts coming in recently, $4.8 million order from the US government, also a $7.4 million order from the US Army. So to kick this off, Mr. Fundamentals, do you have any views on Beam? To give some context, this will be the smallest company on the podcast, depending on the market cap of when you're watching it, somewhere between 80, 90 to just over $100 million. So Mr. Fundamentals, why don't you kick it off with a high level overview of what you think of this company and these recent deals coming through?
Yeah, it's a pretty interesting business. So for their infrastructure itself, it's actually primarily off the grid, meaning that it's a lot more portable and doesn't rely or tap into those main energy sources. And so this kind of makes it a point of differentiation for the business that I think appeals to government entities, particularly somebody like the Army that is moving around a lot. And so I think for them, this injection of cash and faith from the US government is really going to be a testament to the business itself. Overall, the federal sustainability plan is pushing for zero emission vehicles by 2035. And the fleet nearly has about 650,000 vehicles in total. And then just looking at the broader electric vehicle charging station market, it's expected to grow at a compounded annual growth rate of about 25.9% annually. So I think this really speaks to a market opportunity that they are taking advantage of. And then from that point of differentiation, this could help solidify themselves as a key player and supplier for the government in total.
Yeah, I mean, the product itself that I saw was pretty interesting. And, you guys kind of put this one on my radar. It kind of looked cool. Those solar movable charging station for EV vehicles. I've often wondered why there isn't something more like that. Like, it is interesting to see. CEO seems really passionate. But again, coming this from the trend tracker perspective, the trend really isn't your friend right now. And I think a lot of these EV companies in terms of potential has kind of come and gone. So, I think, Declan, I'm going to go back to you a little bit more on what do you think about the financial makeup? Because these guys have really had a slide since that EV kind of pop with them around 2021. They've lost a lot of value. So, we weren't holders in 2021. What do you think about kind of the nuts and bolts of this business and what they got under the hood for longevity? Are they going to be around? Is there any worry here with kind of how much their value's gone down in the past couple of years?
Yeah, no doubt. I think you bring up some good points about the business in general. And, they are a very small player compared to guys like Tesla. And so for them, they're really in the process of building that infrastructure and investing. And as you know, like over the past year, their earnings have taken a bit of a slide. So they were losing already, but they fell from 5 million in 2020 to about 18.8 million over the trailing 12 months. And so they're obviously investing a lot more into the business and trying to expand that presence. But I think that's really key overall in this industry is scale is going to take precedent over everything. And so right now they really need to build up that stockpile so that ultimately they can supply more people and perhaps even find new avenues to bring these portable off-grid charging stations to market in a much more effective way. But there's no doubt, at the company's size, they're going to do a lot or need to do a lot in order to be durable and maintain their presence in this market. But of course, with these new contracts and being able to have a consistent partner in the government is always a promising sign. So if they can continue down this route, I can confidently see them sticking around and doing well. And if they get those losses in order, this could be a business that benefits well over 5 to 10 years.
Well, few things to like, few things not to like. I mean, Pete, to your point, I think the trend isn't exactly with EVs right now. That was a hot sector perhaps in the past. Not to say EVs are going anywhere. I don't believe that. But you look at Tesla, they're giving guidance for a weaker outlook. I think if you're looking at retail consumers, that would typically be the ones to buy EVs. When you're getting squeezed by your mortgage rate, food is becoming more expensive. Maybe the government grants are even disappearing. Maybe it's not quite as attractive to pay for the premium of an electric vehicle. With that said, though, and sorry, then I'll let you get back to that, Peter. Obviously, it seems like they're going after the government more so here. So I think that's a different beast entirely. So I think that, makes my nerves kind of vanish in that sense. But what, something I like is you look at the trend of revenue. It's substantially higher. You look at their latest like Q3, 16.5 million, which is a 150% increase from the same period of 2022. Look at their 9 months and they're looking at 47.3 million. So if you do like a, back of the envelope calculation, that run rate is somewhere in the 60 million range. For a company trading at about a 90 million market cap at first glance, that's pretty attractive. It's just when you get into their margins, it's not a profitable business in the sense, right off the top, their gross profit is either, depending on when you look at it, it's essentially negative or minuscule. So it's, for a company that is in the technology space, you expect for patents, competitive advantage, an economic moat. But if your margins are minuscule or negative, they clearly don't have a big moat. So do they just not have the patent protection? Is their technology not superior? Or are they just not able to get the price? They maybe don't have the pricing power that they might otherwise have, a competitor might have. I don't know.
Yeah, great comments, Kev. And great thing to bring up as well. I'd like to think that they just haven't had their unit economics figured out yet, that there is a lot of kind of technology into this. The efficiency of transfer from solar to these EVs, I think, is something that they'll probably have to work on as time goes on. And then talking about relying on the government, I think we need to remember that this is an election year. Trump having already won kind of 2 nominations and a guy that immediately pulled out of kind of any climate agreement he could. And I think in his victory speech, he even said, we're going to fire up those plants again. So I don't think that's really on the horizon for him. It's just kind of helping this company out. So that's something to be concerned of as well. And the whole 2035 EV thing, I don't buy it, because when you work down the supply chain for that to actually be a thing, it's impossible. You can't get enough lithium, nickel, cobalt to power these things by then. So that's not going to happen. I think that's this like nice pipe dream that a lot of politicians say, but it's really not likely. And then again, not to get too political, because Kev, you brought up some really great points about the company itself, and so did you, Declan. But I think when we're thinking of what might happen with government contracts helping out, I don't know if, the next kind of leaders would be as interested. I was surprised to actually see this as an Army play myself. You'd think that wouldn't be the way they were going. I know it's not a huge amount of money in terms of defense contracts. I think it was a tad under 8 million, which is great for a company of this size. So, maybe not battle ready, but more kind of stateside. And, maybe they're thinking of some things like that. So overall interesting. Yeah, I think if it is like, is it hard for this, stock to go from 6-7 to 10-12 again? I think that would be something I'd be more interested. Not a long-term hold yet.
Mm-hmm. Mm-hmm. Any further thoughts, Declan?
Yeah, I think I share the sentiment overall. Really, like you said, Kev, like this is a really small business, and perhaps even the smallest business we've looked at overall. Mm-hmm. In general, I would just like to see more years of performance to really see the feasibility of that business model. And, there's a lot of exciting things. It seems like there's still many opportunities and room for growth, but you don't want to be in a situation where you depend on one customer or even, these kind of one-off contracts. You need that consistent recurring revenue. And so for them to get in a position where they can do that consistently and then scale effectively so that they are on par with much bigger players, I think is going to be really crucial in these next few years. But again, we're still in an economy that is really uncertain right now, and when you're a small business, you're kind of chomping at the bit to survive. So you gotta do what you can and manage that cash effectively, because at some point, you never know, but something unexpected could happen, and then it could affect your business completely. So you got to be diligent, and just from an investment standpoint, I'd really prefer that it had a few more years under its belt and maybe turn a profit at some point soon.
And to talk about management of cash, look at the most recent quarter. They lost 3.6 million, so that's 1.2 million monthly burn rate. We don't know what the future burn rate is going to look like, but let's just assume it stayed flat. It won't, but let's just assume it will. Based on their cash on hand at September 30th of 14.8 million. Quick math, that gives them about a year to survive, which could be shortened if the loss increases or they lose contracts, or et cetera, et cetera, et cetera. Many things could deter that. So that means they may very well be going back to the market to raise more capital. They recently raised $25 million. So, one of two things happen. Either they go back to the market, they further dilute shareholders this year inside the next 12 months, because if you're raising money when you have 1 month of survival less, you don't exactly have any pricing power with the investment banks. Option two being they fix their net loss problem. And if they could start generating, positive cash flow within the next 12 months, which may be possible. That could be a big call to say it is possible, but I can see a path to profitability. Maybe to dig into that, if you're looking at, if you take a couple, snippets of data for the 9 months ended September 30th, their operating expenses were just under 12 million, which represents 25% of revenues. Look back, same period for the year before, their operating expenses were actually 78% of revenue. So you see a high degree of fixed cost in this business. So that being said, as they fulfill their pipeline of contracts, you could probably make the argument that they may improve their gross margins. They may even get to net profitability. So they're trending the right direction. They're just currently in a fairly sketchy place in a market where people are not so willing to finance net loss companies. They really have about 12 months to prove that they're worth shareholder investment. So I have no further comments on that. Interesting story. I don't know if you guys had anything else to include before we move on to our next story, which is Sunoco.
Nope, you hit it on the head.
Yeah.
Okay, let's do it. Now, here's a company I'd say of the three, this is perhaps the most kind of, how do I say it, picks and shovels. It's an infrastructure play. Sunoco, I don't know if I'm pronouncing it right. It's Sunoco. I've heard British people say Sunoco, so I don't know. However you choose to say that, ticker Sun. That's a company that's been around since 1880. So they've been around for a long time, if, OG is the word here. And they've got a long story of transactions. In April 30th of 2021, Energy Transfer Partners bought Sunoco. Now Sunoco is buying NuStar. So if you want to look into the corporate structure, you spend a few minutes with that. It's an MLP, so it's a master limited partnership. Look the definition up on your own, but it's a publicly traded company. They benefit from the tax structure of a partnership, meaning that if they put a certain percentage of cash flow straight to shareholders, I don't know the exact number. It'll be high if it's anything like a REIT, for example. It'll probably be 80-90% plus. So that is what these guys do. They pay out a lot. It's a very, very low margin business, like very, very low, like 1 or 2% net profit margins, like very, very low, and similar to be said from NuStar. So these are two companies. It's a complementary acquisition. It rounds out the business model, gives it some stability, improves the credit rating. Everything seems to be good. But at the end of the day, this is a low margin business. So why don't we go, Peter, I'll let you kick this off. Just some high level thoughts on these businesses. Maybe if you want to dig into the transaction, you may do so.
Yeah, I think overall the response was positive from the markets. On NuStar, not only did you see a 52-week high, you saw a 4-year high. So people are really liking this deal. On the transaction itself, from my understanding, it's an all-stock deal. And what it does to Sunoco is, like you said, it really rounds it out. It's incredibly complementary that they are stabilizing a lot of their logistics, delivery, and storage, which, could potentially be a problem as certain things keep arising in certain areas, whether it's, getting crude over from the Red Sea itself, where there's been ongoing issues. I think having more control and more insights is definitely a strategic advantage to them. And I think energy's big this year overall. We're seeing it in a lot of different sectors, and there's, I think, going to be a little bit more M&A activity as the time goes on. So I think, it's something for us all to maybe look into and see what we can see with certain trends and what might be coming, because this was a great opportunity for holders of New Energy. And I think it's a good thing for Sunoco in the long run as well.
Interesting. Yeah, so just like on that point, I think it's quite interesting that the business itself has or how it structured the deal. All stock deal. So I think NuStar is getting like 0.4 shares per every Sunoco share, or sorry, every NuStar share that they own. So the big thing that stands out to me there is, like, a lot of the time when it's an all stock deal, it's not necessarily ideal for existing Sunoco shareholders. And that's because, as these shares get distributed, that dilutes those existing shareholders. And on top of that, obviously management believes that this deal is going to increase and improve the value of the business. But since you now own less of that business, it's actually going to affect your gains overall. And so normally I would prefer a company to use cash during transactions like this. But of course, it is a $7.3 billion deal. And the business itself only has about $256 million in cash on hand. And so they can't go or take that path. On top of that, they have about $4.35 billion in debt as well. And so this combination obviously forced them, in order to make this growth move, to do it in a way that isn't necessarily beneficial to shareholders. Now, from a business standpoint, obviously it is going to strengthen the business overall. Sure, it may affect or mitigate cost, and they even said it'll provide about $150 million in synergies over the first 3 years. So there's obviously benefits to it, but it's just more the path they took to actually make this deal happen. Leaves me just questioning, what are management's intentions overall, and did they really consider shareholders in this decision, or was it more a process of, those big guys who have a lot of stake in the company? They know they're obviously going to benefit from this more than, the average retail investor.
And I'm assuming, like you said, some of those big guys, did we double check what subject to approvals this has? Like, is there going to be a vote on this? Or do they think they have the votes to make this kind of go through? I don't know if that's something we need to look up quick, but could be interesting as well. Like you said, during those times of things getting announced to closing can have an impact on existing shareholders in these types of all stock deals.
Yeah, that's a good point. And I actually don't know what kind of options they have for a breakup if the shareholders don't want this. One thing I will say about this transaction that does stand out, this is, like I said, when I say it's a low margin business, I mean it's like a virtually no margin business. Like they barely make money. So when you look at potentially improving your credit rating, like if you can go from being a double B, which I think it was, technically that's junk rated. You're not investment grade. That one, I forget what they call it, going from double B to triple B. I think it's like a rising star or something like that, and the reverse is a fallen angel. And where you look at that is when it's a relatively small change in credit rating can actually make a fairly big difference in what your corporate bond will pay as an interest rate. So even though this may not be the most exciting transaction, other than it being positive for diversification, even a slight change in credit rating, being able to refinance debt, that could make just the savings on their debt could be really significant. When your margins are so low, any kind of savings in interest expense is going to be pretty transformative. And you see Citi just upgraded to a buy, calling this deal transformative. I think this is a company that remains boring. It remains in existence and it remains profitable, albeit I don't see how this company, I don't see the 10x story. You know what I mean? Right. I think this is going to be an excellent MLP. It's going to exist forever. It's going to pay a healthy dividend. And I think it's just going to exist. I don't see the story of how this 10x's or does anything significant. And it doesn't need to. It's just, it removes itself from something that I look at as considering as being attractive.
Yeah. Yeah, and I second that. I mean, a big thing too, to your point, Kev, is I think management is approaching this with the mindset of how do we limit or eliminate unnecessary cost. You know, they sold off 204 convenience stores to 7-Eleven for about $1 billion as well on top of this. And, you know, because it has such low margins, it's really about trying to do everything you can to make the business as efficient as possible. And clearly by upgrading their infrastructure and scaling things out, this is going to allow them to have more control over their business and probably make it more predictable as is. You know, in the oil and gas industry, sure, prices can be volatile, but when you set yourself up for the right infrastructure and you have that scale, it definitely affects you a lot less overall. So I think to your point, you know, by doing things like that and positioning themselves, banking analysts like Citigroup, you know, it makes sense why they gave it a positive rating overall.
Mm-hmm. Yeah, I hear they're actually cutting back to single-ply toilet paper to save some corporate expenses as well. So that's great to see.
Really helped them out. Yeah, absolutely. It's a win.
A win is a win. Pete, any final thoughts there before we move on to the big topic that we're all excited about, which is the WWE?
Yeah, let's get into it. Let's get into it right now.
Right. Okay, screw this other stuff.
Yeah.
Oh God, where do I start here? So, Pete, you're a massive UFC fan. I love UFC as well. I'm familiar with WWE going back to, you know, watching it with my uncle. Now, as people are very aware of, UFC and WWE are now combined into one company, the TKO, what is it? TKO Holdings Group, something like that. And that's a public company. This story, this is a big one. So the story itself that we're going to cover today is that Netflix is going to start streaming WWE. So that's big for a lot of reasons. One, WWE has a very large audience. Two, live events was kind of the final stand of cable TV. Now seeing sports en masse switching over to streaming is going to be transformative for everything. There's one. Two, what stands out to me is think of all the Formula One fans that came out of Drive to Survive on Netflix. Now, if Netflix has rights for WWE, I think it's so likely it would be a no-brainer for them to do something similar. And I can only see that being wildly positive for the WWE brand overall. So that's another thing. I know I've watched a few documentaries and movies about wrestling on Netflix, and that immediately had an increase in interest for me. So I can only imagine going further into that's going to be a good thing. Those are my high-level thoughts on that. There's a lot of things I want to get into on this, but I know you guys are excited too, so I won't hog the microphone here. Pete, you're a huge UFC fan. Do you want to kind of give us some comments?
Oh, yeah. I mean, there's so much to unpack with kind of this news yesterday, but I do want to comment on what you just said, which I hadn't thought of at all. I think we probably grew up watching some WWE, something I don't watch myself anymore. But if there is any type of a Drive to Survive version of the WWE, I am all in on watching that.
I'm all in on watching that.
Definitely catch up. If I could binge that over a week or two, I would absolutely watch that. But so, yeah, I think there's a bit of news yesterday. So there's a $5 billion streaming deal with Netflix, which is huge for the cable industry because that is one of the last things that they're buying. And it's one of the few things that they can kind of stand on is these live sports. And with that going to streaming, it's really interesting because it's not limited to some of these, you know, geographical areas that go with traditional cable, which is great for something like TKO because they can further their reach through these streaming capabilities. But I don't want to miss something else that happened yesterday, that The Rock ended up on the board of TKO. And I mean, love it from a business perspective. And I do not think that this is just some figurehead. I think we have to respect how far The Rock has come from relatively humble beginnings. But this is someone who has went from being one of the greatest entertainers in the world to now becoming one of the biggest businessmen in the world. So he's not on there just to kind of be a pretty face and this entertainer. This is someone who is understanding business and who's really risen through the ranks. And not only that, he knows this business. This is a business his grandfather was in, a business his father was in, and now he's on the board. So this had to be an incredibly proud moment for him, which is awesome to see. But he's really going to benefit. Having someone on your board that's done every job kind of within this company, who's been around it on the ground level, who became a star, who knows what it takes to become a star, who can coach people, who can kind of help develop talent at whatever role they're looking for. And, you know, I mean, his personal deal on that, which wasn't really disclosed, but if you kind of look up some SEC filings, he has a lot to gain as well.
Oh, really? Interesting.
Yeah, as someone who came up with about 300,000 RSUs yesterday. So yeah. So that's pretty good at $85 a share, in addition to kind of the 100,000 he was already sitting on. So he's looking like he has a lot to gain. Shapiro was also named kind of the CEO there, and he was been given a pretty good deal as well. So that came out yesterday. So I really like that The Rock was announced as kind of the board of this new group. And then, you know, who else is kind of a part of this company as well? Well, it's not just WWE, it is UFC, which you and I are fans of. And that is an incredibly fast growing sport. So I think that's really great to see that you have an opportunity to partake as an owner of one of these immensely fast growing and profitable businesses, because we do know the kind of future of sport, and the people behind that are two of the greatest kind of entrepreneurs in the sports business, with Vince McMahon and Dana White. And I think sometimes you can forget the type of entrepreneur Vince McMahon is, because you get caught up because he's on the show and he's acting and he's doing all these things. But when this thing went public, he's sitting on nearly $3 billion worth of stock. God. Like, that is no joke. And, you know, not only are they great entrepreneurs, these two are some of the greatest promoters you'll ever meet in your life. So when these two guys probably turn their mind to, I want more, and figure out, you know, kind of the logistics of getting a stock going, I think the sky's the limit, you know? And when you're comparing this to other sports, like, the cumulative value of NFL teams is around 163 billion. What are we getting this at right now, right? And the overall makeup. So I don't know. I think I can keep talking. I want to open it up to you guys back, because I don't want to rant and take over this whole section, but I really like it, and there's still a lot more for me to say.
Interesting.
Declan, fire away.
Yeah, I mean, like you said, Pete, I think one thing that really stood out to me about this business in general is just how loyal the management team has been. And even with now the addition of The Rock, you know, it really speaks to the belief in the business that the management does have. I let's say I'm not the biggest fan of WWE or UFC per se. I definitely enjoy watching UFC fights, but I haven't watched it loyally by any means. So when I look at it, I think the biggest thing is looking at the business itself. I'm not necessarily sold on the entertainment industry in general. You know, I think there's a lot of optionality out there, and everyone's vying for the same eyeballs. So it can be tough. But that being said, you know, with this deal with Netflix, I think it was the right move to go. You know, for this business itself, by them merging the UFC and WWE, they essentially own the combat sports market. And so it's a really strong position to be in. And whether even perhaps eventually the UFC somehow comes on board with this, I think by positioning themselves on Netflix, they're increasing that accessibility to a lot more eyeballs. Now, maybe somebody like me who has been a skeptic in the past, like you guys said, is watching these documentaries and getting a new perspective on it may entice me more to want to check these things out. And again, because it's no extra additional cost as to my current subscription with Netflix, it's always worth trying something new out anyways, get a fresh new perspective on things. So I think it's one of those things where the deal, it seems like a no-brainer, and hopefully it translates to bringing on new audiences, because I know the existing WWE fan base is really loyal, and they are true diehards, and I think it's similar with the UFC as well. But the big thing for me is how will this translate to new viewers? And if it does, then you know, it's kind of worth just truly agreeing with the business deal and what everybody's saying about it.
I have so many mixed feelings, because if you were to ask me my gut instinct of is this a good company or not, it would be yes. I'd say UFC is a clearly wildly growing sport. WWE is one of those things that's more popular than I realized. It has actually a huge fan base. I was surprised that this is out of the slide deck that I found online. WWE has 1.2 billion global fans to the UFC's 700 million.
That's right.
That stunned me. And I truly think that the value is going to be unlocked in this Netflix partnership with side documentaries. Declan, there's a documentary on Netflix about Paige, the wrestler. I can't recall the name of it. Would you call it a documentary? No, it's not a documentary. It's like there's actors in it, but it goes over her life and the story of getting to the big show. Yeah. And it was really interesting. And I think it makes you much more interested in the storyline of the I almost call them players, what would you call them? Wrestlers, I guess, the fighters. Mm-hmm. So I do think that's going to be wildly beneficial. But what else do I like? I mean, the other thing I like is that, gross margins seem to be really good. If you look at TKO, they're showing somewhere around 71% gross margins. The statements get a little bit confusing, as they often do when there's a recent transaction. I think I would need to see one or two new sets of financials before I would really feel comfortable knowing what I'm working with. But here's one of the things I'm not so sure about. I saw that, so Raw, that's kind of WWE's classic 3-hour show that they put on every week. It had an average of, what was it last time? It was 17.5 million unique viewers over the course of an entire year. Football gets over 16 million in a single game. So WWE, by that standard, isn't a giant. Pete, you look surprised by what I just said.
Yeah, I don't know. I think, is that not the average audience that they would pull? Or
let me quote word for word. Okay, let's see. Regular season game, NFL, on average of 16.5 million viewers.
Yeah.
And then the other quote, this is word for word. This is about WWE. The show is currently the number one show on USA Network, where it brings in 17.5 million unique viewers over the course of a year. So that is, I'll admit, that's a little bit of an apple to orange comparison, but it tells something. That there is quite a big difference.
Football is the gold standard, and it's also getting bigger. But I can't buy shares of an NFL team unless I buddy up with some people and do phenomenally well the rest of my life. So I'd rather grow potentially with something that I can do. I think the Bills Chiefs game this past Sunday was one of the most viewed playoff games of all time, pulling in over 50 million viewers. So it's no joke that it's a beast. But there's things to like about this deal. So I think Monday Night Football itself is a $2.7 billion a year deal with ESPN and Disney. So it's not at NFL level, and I think that's totally fine. It doesn't have to be, because from a shareholder perspective, the $5 billion to WWE and TK Holdings doesn't have the same collective bargaining agreement that the NFL does, or that these other sports unions have, where nearly 50 to 52% of that can be going directly to players. So as a business owner and shareholder, you love it because they don't have collective bargaining. And Kev, as you mentioned, this is more of a monopoly than anything. They really don't have any competitor. They own combat sports, and they don't have employee contracts the same way these other sports do. As a humanitarian, you probably hate it, and you wish that guys who are risking their lives in the UFC for 20 grand a fight should probably get compensated a little bit more, but that's not for me to discuss. I think if we're talking about the dollars and cents of this business, that's a huge advantage to TKO versus some of these other sports. The other thing that's also a huge advantage is these are 52 weeks a year. That is a really big advantage, I think, over some of the other sports out there that have off seasons that, they can't really monetize in terms of content and live events. So, one other thing to mention we didn't touch on as well when it comes to some of these deals and sponsorships is Endeavor actually had purchased, the UFC a while ago, and that's the largest entertainment company in the world, with Ari Emanuel at the helm, who has every contact in entertainment. So another member of kind of this star-studded team also.
Right.
Yeah, it's an interesting structure for those of you watching that don't know this. So Endeavor owns 51% of TKO. The remaining 49% went to WWE shareholders. Endeavor is its own publicly traded company. You can dig into that as you please. I want to go over a few numbers in the financial statements here. And I'll admit publicly to being confused and hoping to figure this out as we go, or maybe come back to this. There's a few things. You look at so first thing I'm going to look at here, I'm going to I'm going to keep the mic up while I look at my other computer here. But if I'm looking at the net income, okay, for the 9 months ended 2023, it's showing $1 billion here. That seems light. So there's definitely some accounting going on here with the two transactions. I was under the impression that both the UFC and WWE individually did over $1 billion revenue. So there's something to look into here. Now, when you do a transaction like this, it's very, very recent. Like it was in September, this closed. There's going to be some partial accounting and stuff. So I'm just going to consider this to be some kind of Frankenstein income statement until I see something more up to date. But even at a top look, you see $1 billion revenue. Gross margins, pretty much 70%. So fantastic gross margins. Everything looks good until you see a couple red flags. One, $172.4 million in interest expense. So massive interest payments going on here, which eats up a lot of that. And then the final line item here, where they'll finish with net income of 191 million, which I'd say, you're at 20%. I'd be happy with that. Then they deduct $235 million, which says net income attributable to TKO operating company prior to the transactions. So I'm trying my hardest to wrap my head around that and what the deduction is. So I don't know if you guys know what that is. I'm assuming you haven't had time to do forensic accounting on this and figure out what that is. But
yeah, I would say it'd be interesting as formerly privately held companies, what benefit there were for the initial shareholders before going public and what they could claim
for one, there was a
themselves
dividend
along the way. Yeah,
there was a dividend. So could that be somehow related to some kind of liability or payment or something? Maybe there's something there. So maybe that answers it.
Yeah.
The other thing I was going to say that stands out is on the balance sheet. So if you look through and you quickly take a look at total assets, 12.7 billion, and then you look at total liabilities, 3.7 billion, you're like, okay, clear coverage. That's not a problem there. You dig into their assets further. 3.6 of that is intangible assets, and 7.6 billion is goodwill. So you have these difficult to understand assets. So that basically removes the majority. That's over 10, 11 there. So that's like literally the bulk of their total assets. And then you look at their total liabilities. Okay, fine. There's 3.7. 2.7 of that is long-term debt. So it's a questionable set of assets and a very real set of liabilities. So this company may very well have a liquidity or solvency issue on our hands here. Without digging into the goodwill and intangibles more, I don't know. But from a first glance, it's definitely something that makes me stop, take a moment for pause.
Yeah. I think of that note too, like it is a good point that they've kind of run their balance sheet and maybe the questionability of it all. But, to be fair, like the company, and again, this is based on my understanding of the financials, is that they have been cash flow positive and bringing in profits overall. So there is a certain degree of stability in that sense. Now, just from an investment standpoint overall, and I think this goes back to Pete's point, is, there may not be many opportunities to get into the entertainment and even sporting industry at large. But I really what I always like to do when I'm comparing investment prospects is just compare one business to my other existing businesses within the portfolio and ask myself, like, is this going to add value to the overall portfolio, or is it, are my existing positions much more attractive in general? And so I think with a company like this, they've definitely done a lot of good things recently. Management is tied closely to the company and has been there since pretty much day one. The big thing is just like how much room for growth really is there in an industry like this, to the point about the NFL, like, and again, based on the market cap on just Yahoo Finance, it says it's about like 7.8 billion. Well, one NFL team is pretty much closely valued at that same amount. And so I think it's a matter of, how much room for growth. And then just another point that you said is, what risk exists with the fighters themselves. And if they aren't satisfied with their current payment structure, and, especially with all this new exposure, what happens if they start to walk out or boycott? Like, there's a lot of dependency from that end. So I just think when I look at it compared to other businesses that I own or even other prospects out there, it isn't that attractive overall. And that's why I'd probably stay away for now.
Fighters will just start fighting Jake Paul one at a time.
Yeah,
exactly.
I mean, that's already they've had failed attempts at the WWE side of walkouts. So it's there isn't anything else. It is a monopoly, and the only other thing that was similar that you would have thought was a monopoly was golf, and the people who funded that are already shareholders of this.
Right.
So the same Saudi fund, the Sovereign Wealth Fund that started a rival league that was able to buy some of the top players in golf, which has really gutted the PGA, because the PGA was a very similar setup to the UFC and WWE, that these people were independent contractors. They weren't employees with guaranteed contracts like these other leagues. But at the same time, Declan, I don't think you're realizing how much the sport's grown in the past few years. Interest in the UFC is up 3-4x in the last 4 years alone. The UFC was just here on Saturday night in Toronto. Toronto's third largest city in Canada, the United States. The record gate for a live event at the Scotiabank Arena now belongs to the UFC. And we had the NBA Finals here in 2019. So
wow,
that's kind of giving you some context that it is very popular and trending the right way, and it has operated like a private business for a very long time, where it didn't have access to a lot of this third-party funding, and that it was fundamentally good. And how much more content can they put out will really be dependent on its future. And I'm not gonna slag a business that just sold one night of the week for $5 billion.
Touche.
That's fair. Yeah.
Touche.
Yeah.
Well, I wanted to bring up an interesting point here. I was reading through the risk factors, which something I'll poke through. They're usually pretty boilerplate standard, but this one had something interesting. And then I'm going to drop a hammer. So the risk factor summary was, quote unquote, because our success depends substantially on our ability to maintain a professional reputation, adverse publicity concerning us or our key personnel could adversely affect our business. There's point one. Point two, and I'm going to open up some insider trading reports. I was mentioning this to you guys. If I look back on November 14, Vince McMahon dumped 8.4 million shares at an average price of $76. So Vince McMahon dumped an enormous amount of shares. I then saw a piece of news this morning, and I mean like an hour ago, where Vince was just named in a trafficking lawsuit. Now, the terms of which I will not speak out loud because they're actually pretty gross and gruesome. And I don't want this video to be flagged by YouTube. But if you flip through the lawsuit, it's a doozy, and it's very specific. There's a lot of detail. It's not a good look. And I don't think that anyone is going to be shocked to hear that Vince McMahon may be a shady guy. I think anyone who's watched a wrestling match through the years, you've seen him be wildly like sexist on stage. It'll be nothing new. This was a pretty gruesome story, though, a lot more specific. And the timing is not great with this share dump. It is not great with this being a newly traded company. And that is a serious risk to the business. Do people boycott WWE because of this? I'm not saying that's what's going to happen. I'm just saying that that's a risk that's presented itself. I'm not sure. This news is so fresh. I don't know if you guys actually had a chance to flip through this, or am I the first person breaking this to you?
Yeah, it's an absolute hammer, and I did not see that. And thanks for letting me endorse this company as long as I did.
I'm sorry.
So I just want to get this on the record that I had no idea, and this is all news to me, and I'm going to have to read about this after. So thanks, Kev. Good investigative work on your end. Obviously, I think that's an issue. This type of business is going to have, I think, less than stellar news about its athletes, and that's very common, I think, in some of the bigger sports. There's issues all the time with giving 25-year-olds who are pent up with testosterone millions of dollars and very little oversight. So that's not
a massive amount of fame.
Yeah, exactly. So I think that, and I mean, they fight people for a living, so I think they encounter a lot of things that we don't when we go out, right? They're not anonymous. They get approached. People are fueled with alcohol when these happen. But do I expect it of an executive board member, or usually not as much. I mean, Dana White was also involved with something that wasn't
the
great over New Year's. Won't
slap,
get into
right?
on on camera. I think when you look at some of the, like I said, people in entertainment that are part of this, that disappeared incredibly fast. I don't know what happened with it. Not going to comment too much more on that, but in terms of the sport and the product itself, I think it's great, and I think it's a well-run business. But you're right, that is a threat that would likely have a shorter term impact over the stock. Declan, I think when you commented on, is this benefit your portfolio? I don't think this is a quick trade. This would be, for me personally, an average in over time, because in 10 years the sport's still going to be here and it's going to be bigger than it is today.
Yeah. I just wonder, like, as this business, because they've merged and now they, outright own this market essentially, how that'll affect growth over the long run. Because, now that you're in this position where you don't really have that much competition within your space, what can you really do to, like, push yourself when somebody's not, like, nipping at your heels and challenging you to do something different? And I think that's what did exist when they were, rivals at some point. And of course, they're in different fields. One's not real fighting, and then the other one is obviously like true combat. But that being said, they probably have very similar demographics. And so before they had to go at each other, but now will this form into like a bureaucratic situation where they start to move a lot more slowly? They don't really like challenge anything because they can already like milk the money that they build from their audience. And so, I don't have the answer to it, but I think that's something that is, anyways, worth paying attention to, is how this manifests now that they don't really have much competition in their market anymore.
Well, you know what I would quickly say, just one quick point, is that the biggest fire that you can ever light under management is making them a public company and having thousands of shareholders focused on, well, now they have full transparency into your operations. And if your audience is declining year over year, it's going to be no secret to the world. They've enjoyed the benefit of being a private company for as long as they have. It's going to be different now. And I wonder, things like you see of bringing Logan Paul into the WWE to try to attract a younger audience. Maybe they're doing more things like that. How you see Brock Lesnar go from the WWE to UFC. Do you start seeing more crossover? I'd be curious to see what that looks like. I don't know, but I do think that maybe the competition, maybe they do have a monopoly and that'll make you lazy. I would hope that being a public company would hopefully more than make up for that, but it remains to be seen.
Right. The Rock actually addressed you directly yesterday, Declan, on your concern. His exact quote was somewhere along the lines of, when you're coming up in the world and you kind of think you've like achieved something and you get there, like you're climbing a mountain and you get to a certain point and you think, oh, I've arrived, like I'm here now. And he said, then you learn there's more mountain to climb. So, that's someone who's obviously incredibly driven, and these guys aren't looking to stop with the audience they have. And I think the real opportunity here is this is a really global sport, unlike a lot of the things like, something like the MLS and soccer has not taken off in North America as much as they would have thought. Go to Europe, go to the rest of the world. Soccer's an absolutely huge game. NFL trying their best to kind of, bringing fans in Europe and having games over there, but it's not resonating nearly the same way. UFC can go anywhere in the world and sell out. They've done events in Australia, in Europe this past year, in South America, in Canada, all over the United States, and they sell out. And that's because they're actual stars. Right now, the UFC has champions from 6 continents. So, and mixed martial arts is a global sport, and people are interested worldwide. And I think, you're starting to see that. And with the abilities of streaming, you're going to see that more and more.
I feel optimistic. I think that, seeing the WWE leaning in on kind of their core expertise of being very great shape acrobatics. Like if you watch some of like Logan Paul, a great example. Hey, love him or hate him, the guy's an unbelievable athlete, and the acrobatics he's brought to the WWE has been wildly impressive. So maybe they focus in on maybe it's less on the theatrics and, the fake punches, and more, it becomes more of a sport for just pure entertainment and acrobatics. Regardless, with the content that they have, the content that they can create, the audience they have, this Netflix deal, minus Vince McMahon, this company seems to have a lot of positives going for it.
Yeah. I only want to address one more thing, as it is down from the IPO. And I think from our audience themselves is understanding that not all IPOs are necessarily just these capitalization events, that they are liquidity events. And when you've had some of these guys be shareholders their whole life, granted they're profitable taking dividends, can you fault a Vince McMahon for taking a $700 million payday if he has people he wants to take care of, other opportunities as he's stepping away from the business over time? And this is something that I think is really common, and it's not like the SEC can just give you a fire sale. You're not necessarily allowed to sell all those shares all at once, depending what type of restrictions they put on. These deals are treated differently. You have the bankers themselves who are often compensated in forms of equity or RSUs or options. Declan, your buddies Moelis were on this deal as well.
Oh, really?
No way. Yeah. Moelis was on the advisors of the WWE side as part of this deal. So if you guys want, I tried to get a little bit more into the cap structure on their prospectus. It's 715 pages. So I didn't, I did kind of look at some of the interesting beneficial owners, but Vince was sitting on a lot of shares. He was still a very big shareholder. A lot of management insiders were still holding. And, with it, they had the opportunity to sell. I don't necessarily blame them because they've been such long-term shareholders of this business, and, everyone deserves a payday.
That is fair.
Yeah.
That is fair. Well, I don't know if we can squeeze anything out of this story. I think that's about it. Guys, did you have any final points, or are you feeling good about this?
Yeah, I think that's like a good summary of the whole transaction, as well as like the business in general. It's definitely positioned itself well with some competitive advantages, and really to me it's just a matter of how much growth do they have. So that's we'll wait and see, but nonetheless it's exciting to see them on Netflix, and I'm gonna have to check out that documentary and see what new shows come about because of this.
Totally. Peter, before we were talking about Klaviyo potentially pitching that, do you want to pitch that stock today, or do you want to save that for another time?
I'd love to chat about it if you guys have the time. This is something I've liked for a while. So Klaviyo, again, recent IPO that is trading a little bit down from the IPO itself. Nothing necessarily uncommon we've seen lately, especially in the tech sector. But there's a few reasons I really like this stock. I've been bullish on CRMs and kind of the implication AI will have on them, but particularly their room for improvement. So Klaviyo has been around for a while, but it found a very unique partnership with Shopify early on, and it has seen significant growth. So we are talking about email marketing, SMS marketing, and like maybe other people that are listening know of the MailChimps of the world or some of these other companies. And I like what they're doing. I like this as a user, as someone who works in digital marketing myself. This is something I've used hands-on, and it is incredibly user-friendly and incredibly good in a sense of getting B2C customers. So that's really where a big part of their core competency is in e-commerce, to have personalization and email marketing and SMS. But that's really a starting point of where this company could go. So that's really what I like about them. Is their valuation could it be deemed as a little high right now? Maybe. So again, is it more of an average longer term hold for me? For sure. But when you can think of some comparables in the space, you can see a HubSpot that's a $30 billion company, and a gold standard in the CRM world of Salesforce that's a $270 billion company and has returned 7,000% gain since inception in 2004. So there is a lot of blue sky with this company. They have a really great team. And Shopify is actually their largest shareholder at 44%, which they kind of disclosed over their IPO transaction. So overall revenue before their IPO transaction was 642 million annually. That represented a 54% growth, which I really liked. Declan, they have 15% free cash flow. They are profitable, which is generally kind of unheard of, I think, a little bit in the tech space when you're looking at some of these go public transactions. And they have 135,000 customers and growing. So that's really what I like about it. So I can definitely speak some more, but I'd love to open up to you guys on some of your thoughts about this business.
Well, just a quick couple points. So the Vancouver Resource Investment Conference had me occupied this week, so I'll be doing this in real time. Other than knowing the name of the company, I'm not familiar. I've been hearing a lot about there being a pretty significant recession for SaaS companies, meaning as companies come under the pinch, they're not able to raise the same amount of capital. They're obviously making big layoffs. They're also looking to consolidate a lot of their SaaS tools, leading to a lot of pricing pressure. I don't know how that's impacted Klaviyo. The fact that they just did an IPO and things, I mean, maybe they're trading down slightly, but they completed a successful IPO. I'm assuming they've somehow skirted past this. Have they been able to hang on to their revenue through the last couple of years, or what's that look like?
So I think what's interesting is how they grew, and they grew a lot through their developers and partners. So no, they're consistently growing in revenue and users quarter over quarter, year over year. So I don't think they might be the target of this tool slowdown or the SaaS slowdown of companies looking to cut, because they actually have solopreneurs using their tool. They have small businesses using their tool. But number one, it is often recommended by their partner program and their developers. So I think that's what's really interesting is they have 5,000 partners right now, which are digital marketing agencies, email marketing agencies, SMS marketing agencies that say, or developers that say, hey, if you're getting into this, use this tool. So comparatively, HubSpot, which is a $30 billion company, which is, a little bit more of that B2B focus, has 6,200 partners. So they're already at 5,000 partners. That is something I really like. And again, we managed to make it through the majority of this pod without saying the words AI.
Yeah.
But this is where I think AI has some of the biggest impacts in CRMs. I think CRM companies are going to be some of the biggest winners there due to the leveraging 1P data. And then you can create personalization. And the CEO himself recently said in an interview, would you consider yourself an AI play? And he says, absolutely. So, really
good answer.
In 2024, that is a great answer. I don't know why he hasn't rebranded as Klaviyo.ai. Probably would have doubled in value overnight. But it's in their deck that that they want to use this in a meaningful way. And Declan, this is something you and I have chatted about. That meaningful way is leveraging their own data, and they'll have billions of points of data as time goes on, and leveraging their own unique machine learning models, which will be proprietary to them. And that will have a ton of value. As we've seen companies like on the big side of things that are really being branded as an AI play, with Microsoft seeing a lot of advantage from this and NVIDIA, I wouldn't sleep on these guys and what they're going to be able to do.
Right. Very interesting.
Yeah.
You don't happen to know what the churn rate would be? I don't know if that's something they list in the statements.
So they haven't listed necessary churn rate because quarter over quarter users is going up. SaaS tools have churn, right?
Yeah.
But when you build something around this is what I also like, that I really see their customers growing with them. And as they launch new features, they're actually going to be able to get more average value from these 130,000 customers, and however many grow next month and the quarter after that. But as they launch new services, they have the ability to kind of cross-sell and upsell while growing. And then they do have a strategy now that they are moving more to a mid-market and enterprise solution. And that's where you can get some really big sales happening. Once you start doing that, as their customers themselves grow, a lot of people are building on Shopify. 80% of their revenue is on Shopify, which a lot of people don't like. But for me, that just spells nothing but opportunity as they can go into WooCommerce and other e-commerce platforms that are popular.
Right. Interesting. Just to chime in here a bit, Pete. So first and foremost, just wanted some clarification on the actual profitability of it. From my understanding, they still are at a net loss overall from a net income standpoint. They lost just in the past 9 months about $297 million, which is a pretty significant jump from the year prior's information. So I was kind of just like on that note more than anything is, what really is going to differentiate Klaviyo from these other key competitors, as you mentioned, like HubSpot and Salesforce are a lot larger and have greater economies of scale in general. So what are they going to be able to do to really separate themselves there? And then just on top of that, just, again, if it is true that the net loss is that substantial, how are they going to, what is their path to profitability, and what is going to ensure that they can maintain growth and just be able to not necessarily have to dilute shareholders? So yeah, just kind of curious on your thoughts on those matters.
Yeah, I think that's a great question. And I guess I'll correct myself that the numbers I was referencing were their pre-IPO numbers for sure, where they were profitable pre-IPO. And it was funny in an interview I watched on these guys recently, the CEO was actually asked that question, do you see yourself still being profitable? And he definitely skirted that. So he was like, yeah, well, we'll see about that. I mean, they're looking to invest in this tech, and that's not cheap. That is hiring. We've seen a lot of hirings and firings across the tech sector. And I think what they're able to leverage is these data points and how they're going to be using this for personalization for advertisers like myself to get a better return on investment by using their product. So when you're leveraging that, I think no one has a problem with the massive losses OpenAI is mounting by developing AI technology. So think of it, I think, in that way. And I can't see exactly what a Salesforce is leveraging right now behind the scenes. I think a lot of these companies, these CRM companies, will keep their cards a little bit tight until they do that next release. But I'm confident that, with the functionality they've released to date, that they're going to continue to go the right way, because users and marketers and developers love this product and recommend it. And I think when you see that, I think that's, very positive. So that's a point of differentiation. HubSpot and Salesforce, aren't the best B2C solutions. Salesforce, to be honest, is not a great e-commerce CRM. We've kind of had to use it in the past with certain clients, and I wouldn't say it's one we'd recommend. B2C, yeah, it can be okay as well. But as an e-commerce tool, this is really where Klaviyo is today, and now looking at expanding elsewhere.
Yeah, I've used Salesforce too much in the past. And one of the big things is it's actually really, really expensive when you get to be an enterprise. I recall us bringing in a team of consultants for implementation, customization. It was many months. It was very, very expensive. Everybody hated it internally, I'll say that. Now, mind you, take that with a grain of salt, that a lot of people were significantly older than I am. So just generally against new technology implementation in general. But my personal experience, I'd say it wasn't the smoothest. I use ConvertKit and MailChimp the most. I've had good experiences with both. I'm actually not familiar with Klaviyo's user interface. So maybe that's something I go poke around to get a firsthand look at it. Because just like you said, Pete, I've seen it recommended time and time again.
Interesting. And just like one final question kind of on it, Pete, is, so HubSpot has like a $30 billion valuation, and Salesforce is in the stratosphere kind of right now. Of course, they have a lot more elements, but I'm just kind of curious, like, what valuation you would assign to a business like this, and just comparing it to its competitors, but also its unique positioning, where you think that value stands.
I would say you can look at Intuit's acquisition of MailChimp not too long ago. Now, MailChimp was a little bit older of a company and did have higher users, and this is trading at a premium to that acquisition for sure, if you're looking at it compared to revenue and even some of the bottom line factors. But you see that with public companies a lot of the time. You do see that premium over some of these, private acquisitions. I don't think that's uncommon. And that's why I'm saying it's not an immediate buy. I don't think, let's say, maybe today's value is the lowest it might go. I think obviously it dip for a lot of reasons we just said, that there are liquidity events that happen. There could be senior executives, employees vesting, bankers, reasons to sell along the way. That's why you'll see things kind of dip after an IPO. But I think that the future is incredibly bright, and we do have a decent size acquisition in the recent couple of years with MailChimp selling to Intuit.
Right.
I actually missed that. I didn't notice that. Well, I have Klaviyo on the watch list now. You're right, it is a fair bit down from the IPO, so maybe that is an attractive point to look at. Definitely something we'll bring up again. Did you guys have any final points on the stock? I would say I have nothing further that I can add without further research. I don't know if you guys wanted to conclude, or how are you feeling about this?
Yeah, no, all good. Thanks for pitching, Pete.
Yeah, thank you, Pete.
Thanks.
Okay, guys. Well, this was a jam-packed episode. We covered a lot of ground here. Thank you for the pitch at the end there, Pete. Guys, watching, this is episode number 7. I've got my partners with me, Trend Tracker, Mr. Fundamentals. I am Small Cap Kev. If you find this useful, hitting the like button goes a long way. If you want to be up to date, make sure you subscribed. As I said, we record this every Thursday, release it every Sunday. Until next time, thank you guys for tuning in.